Welcome to this video on IAS 8, where we will be discussing changes in accounting policy. Now, IAS 8 deals with not just changes in accounting policy, but also changes in estimates and accounting for errors. In this video, however, we will only be looking at voluntary changes. So that is when an entity decides to change their accounting policy because they think it would more fairly represent the business's financial position or financial performance. Okay, so let's get to it. In this video, we will be discussing how to account for a change in accounting policy, and this will be in terms of IAS 8. Like I said, we will only be focusing on voluntary changes, and if you want me to cover anything else from IAS 8, go ahead and leave a comment right now, and if you haven't done so yet, please subscribe to my channel. Okay, and then we're going to focus on a practical example. So this example I made up from scratch, and I hope that the numbers are going to work out because these things always catch you by surprise because you always forget something when you make up examples. But the reason why I had to make up this example was because in the illustrative examples of IAS 8, they don't have an example of where a voluntary change in accounting policy is applied retrospectively. Okay, the example that they have is a change in accounting policy that's been applied prospectively. So I thought I would do this example. We're going to be looking at investment property, and hopefully once we've gone through this entire example, you will feel more comfortable with how to deal with a change in accounting policy. Okay, so in terms of IAS 8, there are some key definitions that we first need to look at before we can get started. So the first definition I'd like to discuss is that of an accounting policy. And really what the standard here says that accounting policies are specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements, right? So for every sort of line item in our financial statements, we need to have an accounting policy, and that's normally disclosed in the notes to the financial statements, so that the users of the financial statements can understand how we've derived those numbers at least. Okay, and so for all of these numbers, we have to have some sort of accounting policy, and IAS 8 it will give us guidance on how we end up selecting those policies. The next key definition that you need to be aware of for this video specifically is that of retrospective application. So retrospective application means that we are going to be applying our new accounting policy to transactions, other events, and conditions as if that policy has always applied. So what would happen is that our financial statements effectively are going to be restated to reflect what our financial statements would have looked like if we had always applied this accounting policy. Okay. Now, let's get into how to account for a change in accounting policy. Now, paragraph 14 states that an entity can only change its accounting policies when it is required by an IFRS, or if it results in the financial statements providing more reliable and relevant information about the entity's financial position or financial performance. Now, like I said, we're not going to be dealing with changes that are required by IFRS. We're only looking at voluntary changes. So this is really the second part over here, where it's going to result in a more reliable and relevant information regarding the financial position and financial performance of the entity. Okay. Now, changes in accounting policies are applied retrospectively, and if you go and read the standard, it also talks about instances that are not considered to be changes in accounting policy. So that would be, for example, the application of an accounting policy for transactions that differ in substance from those previously occurring, and the application of new accounting policies for transactions that did not occur previously or were immaterial. So those two circumstances really are examples of things that are not a change in accounting policy. Here we're saying that Okay, the business has decided that if they change this accounting policy, the users of the financial statements will get better information, right, about the business's financial position and performance, and therefore they believe that this is a better policy to embark upon. Okay. The entity, in applying this retrospective application, right, the entity is going to adjust the opening balance of each affected component of equity for the earliest period presented, and the other comparative amounts disclosed for each period presented, as if the new policy had always been applied. So what this is saying is that when you present your financial statements, you're effectively going to restate your equity balances. Okay, so your prior year comparatives, you would restate your opening balance of your equity that has been affected by this change in accounting policy, as well as the line items in the financial statements that are now changed because of the accounting policy. Now, these changes you're only going to do if it would be practical for you to do so. So the standard says that if it's impracticable to do this, then you wouldn't apply the change retrospectively, you would apply it prospectively. And like I said, there is an example in IAS 8 in the illustrative examples, which deals with this prospective application. The thing with the prospective application is that there's just going to be a difference in what you include in your accounting policy note. But like I said, in this video, we're only dealing with a voluntary change that is being retrospectively applied. Now, in terms of the disclosure requirements, okay, the disclosure requirements are given in paragraph 9, and they require that an entity is meant to disclose the nature of the change in accounting policy. So that means that the entity needs to explain what has changed, okay, what about the accounting policy has changed. So for example, if we think of our investment property, and that's the example we're going to look at, the entity has gone from the cost model to the fair value model. Okay, so you have to explain the nature of the change. Then you also have to explain why the new accounting policy provides more reliable and relevant information. So think about it again with our investment property example, which we will look at. If you are reporting your investment property at fair value, that gives the users of the financial statements a better indication of the financial position of the business, because the asset then is being fair valued, and that is a much better depiction of the value of the asset than a historic cost, for example. Okay. Nextly, for the current period and for each prior period that's been represented, to the extent that it is practicable, we need to disclose the amount of the adjustment for the financial statement line item that's been affected. And if IAS 33, which is the earnings per share standard, if it applies, then you must disclose the impact on basic and diluted earnings per share. So that would be in the case of a listed entity, for example, where IAS 33 would apply. Okay, you would also disclose the amount of the adjustment relating to prior periods before those presented, to the extent that it is practicable. And then lastly, if our retrospective application is impracticable for a particular period, then we are going to have to describe the circumstances that led to the existence of the condition and that makes it impracticable, and a description of how and from when the change in accounting policy has been applied. Okay. Now, the last thing to note here is that financial statements of subsequent periods do not need to repeat these disclosures. So once you've done it in the current year, and you've done that retrospective application and you've done all your disclosures, you don't have to repeat those disclosures going forward, because you've already restated your financial statements. Okay, so that, broadly speaking, is the theory that IAS 8 gives us relating to the a voluntary change in accounting policy, where we are going to have this retrospective application. And now I'd like us to look at an example, like I said, with investment property, where we're going to look at the numbers and see how exactly this impacts our financial statements. So we're going to be looking at how we would record journal entries for this transaction, as well as what the ultimate effect on the financial statements are going to be. So welcome to this worked example on a change in accounting policy. In this question, it tells us that we may ignore taxation, and we are very happy about that because taxation always complicates things a bit more. But I think it's important that we just ignore tax for now, look at the underlying principles, and if you want me to tackle an example with tax included, then leave me a comment and I will make sure that I get to that. Okay, so we're looking at entity A. Entity A is not listed, and the significance of this is that if entity A is not listed, then IAS 33 doesn't apply, and then we don't have to do those additional disclosures around our basic earnings per share and our diluted earnings per share. So we're happy about that. Okay, and there's a financial year end of 31 December. Okay, now we are told that entity A decided to change its accounting policy with respect to investment property from the cost model to the fair value model to present the value of investment property more fairly. Okay, so they more fairly want to represent the business's financial performance and financial position. The accountant has recorded the current year movements under the old policy. So that's very important to note, because it means that everything the accountant has done, the bookkeeper and the accountant up until now, is recording transactions related to the investment property as if they were applying this cost model, which IAS 40 permits. Okay, so the information that we're dealing with has been prepared under this old policy, and we now have to take this information and then make sure that we actually account for the new policy. Okay, so we have been provided with the following information before considering any adjustments as required by the information above. So the cost of this property on the 1st of Jan X1 was 1 million. Then we are given the fair value of the property for the end of X1, X2 and X3. We are also told the estimated useful life, the residual value and the method of depreciation. And this is important because under the old policy, okay, which is the cost model, we would need this information to calculate the depreciation. Okay, so that is why that we've been given that information as well. And then we're told that retained earnings at the 1st of Jan X1 is 2 million. The profit for years X2 and X3 has been given over there, and the significance of that number is that we now have to, when we're doing our various disclosures in the financial statements, we're going to have to pull those numbers through. So let's get into the required of this question. Okay, the first required tells us that we need to prepare the adjusting journal entries to record the change in accounting policy in the general journal of entity A. So we need to prepare the journal entries for the change in the accounting policy. So let's get started. Now, in order for us to process the adjusting journal entries to record the change in the accounting policy, we need to get a sense of what has already been recorded, and then we're going to compare that to what needs to have been recorded to affect the change in accounting policy, and then we're going to do the adjustments from then. Okay, so we're going to look at the numbers under the old policy, look at what the numbers should be under the new policy, and then work out our adjustments from there. So our starting point when we're dealing with these types of questions, always a timeline. Okay, I cannot stress the importance of a timeline enough. A timeline really helps you visualize what it is that you're doing and gives you some direction for the rest of the question. Okay, so under the old policy, okay, remember we're dealing with the cost model. Okay, so under the cost model, we would have been depreciating this asset under a straight line basis, as we were told in the scenario information. So let's quickly calculate what the depreciation would be per annum. So the depreciation is going to be, the question told us that the cost of the property was 1 million. Okay, it had a residual value of 500,000. We were depreciated in a straight line over 20 years. So that gives us a depreciation of 25,000 per annum. So every year we would have had depreciation, okay, of 25,000. Okay, that would have been recorded every single year. Now, we've got to think about, okay, what the cumulative effects of that policy is in the financial statements as they stand now, before we even implement the new policy. So we know that if we're looking at the year X3, so let's just focus on the year X3 for a moment, right? We would have depreciation in the current year of 25,000. Then we would also have accumulated depreciation, which would be the sum of the 3 years over there, which would be 75k. The other thing we would have is we would also have the property, okay, cost account, and that would be sitting at 1 million. Now, IAS 40, when it talks about the cost model for investment property, it basically directs us back to IAS 16. So like we would treat an asset in IAS 16, where we have a cost account and we have an accumulated depreciation account separately, and then we offset it when we present it on the financial statements, we're going to have the same thing over here for this investment property. Okay, and the other thing to bear in mind here is that our retained earnings overall is down by 75,000, and this is the cumulative effect of the depreciation that we have processed over 3 years, because this would have reduced our retained earnings at the end of the year by 75,000 in total. Now let's think about what it would have been, what it should be under the new policy. Okay, so in terms of the new policy, what exactly is going on over here? In terms of the new policy, we expect that the property would have been recorded on the fair value model. So that means that every year we expect some sort of fair value gain or loss that's going to go through profit or loss to be reflected. And there would be no depreciation if the property is carried on the fair value model. Okay, so ultimately what we need to calculate is what would have been the gain that is recognized in each year. Now, in order to get this gain, we're going to look at the fair value of the property. And in the first year, we see that the property is, the fair value at the end of X1 is 1050, and it's starting at 1 million. So that gives us a gain of 50,000. Okay, the next year, okay, so it goes 1050. The next year, the property goes up to, it's 1240. So that gives us a gain of 190k. And then at the end of X3, the property value goes up to 1350. So that gives us a gain of 110,000. So those are the gains that we expect. So if we were to summarize in the year X3, what do we expect to see in the financial statements? Well, we expect to see a fair value gain, which is the 110,000 over there. We expect to have our investment property on the statement of financial position at that amount, the 1350. Okay. And overall, we expect that our retained earnings should increase by the sum of these revaluation gains of a year that we have recognized. And in total, I think that brings us to, let's see, 2, 3, that is 350. Okay, so that brings us up to 350,000. So we expect that overall our retained earnings should be increased by 350,000. Now, What we need to do now is we need to process the adjusting journal entries. And with the adjusting journal entries, effectively what we want to do is we want to go from this, okay, to this. Okay, so how do we go about that? Okay, so let's think about the first thing. Okay, let's look at just the current year. Okay, the first thing we have here is that we have already recognized we've already recognized a depreciation expense of 25,000, but we know that that depreciation should not be recognized because it's the fair value model, so we're going to have to reverse that depreciation. So depreciation expense would be credited, it would have been debited initially, so we're going to credit our depreciation expense with 25,000, and we're going to then debit our accumulated depreciation on our property, 25,000. And as a narration here, we can just put we are reversing the current year depreciation. Okay, so that is our first journal entry that we need to process. The second journal entry is, if you look at under the new policy, so we expect to see a fair value gain of 110,000 in the current year. So we need to actually go and process that fair value gain so that it can now be reflected in our financial statements. So how would we do that? We're going to recognize the gain in profit or loss, and we're going to increase our investment property. Okay, so we're going to debit our investment property with 110,000. And we are going to credit our fair value gains in profit or loss with 110,000. So with that, we are now recognizing the correct fair value adjustment that we expect to see there. Okay, what else do we need to do? Okay, well, we know that in prior years, so we've already reversed the 25,000 over here. Okay, let me just highlight it. We've already done a reversal for the current year depreciation. But we have to remember that in prior years, we depreciated this asset as well. So there was 50,000 depreciation in total. And that depreciation would have been closed off to retained earnings. So our retained earnings was decreased because of that depreciation over there. So now let's go and do a reversal for that depreciation. Okay, so we would have credited our accumulated depreciation. So we now have to debit our accumulated depreciation, okay, on the property with 50,000. And what do we credit? Okay, in our first journal entry, we credited a depreciation expense, but this is depreciation relating to the prior year, so we can't credit depreciation expense. Depreciation expense would have been closed off to our retained earnings, so we go and credit our retained earnings. Retained earnings. And as a narration here, we can say we are reversing prior year depreciation. I just realized I didn't do a narration up here for the fair value gains, so I'll just do a narration quickly. So we're going to recognize the fair value adjustment, okay, on investment property. Okay, and now the last adjustment that we need to do is, okay, so if you look at what we've done in terms of the new policy, we've already recognized the current year fair value gains relating to the investment property. But because we're applying this policy retrospectively, it means that we apply it as if it has always existed. So therefore, we are going to take the fair value gains that we previously would have recognized, and now we're going to bring that in as well. Okay, so the cumulative effect of those would have been 240,000. Okay, so we're going to debit our investment property with 240,000, and we're going to credit. We can't credit our fair value gains because those fair value gains would have had to be recognized in the prior year and would have been closed off to our retained earnings. So we're going to credit our retained earnings 240,000. Okay, and our journal entry there would be recognizing prior year fair value gains. Okay, and those would be the adjusting journal entries that we need to process in order to recognize the effect of the change in the accounting policy. We would also have to probably recognize a journal entry for the reclassification of the property because it goes from the cost model onto the fair value model. So we just have to recognize that property, reclassify it as investment property, but we'll just do that in our disclosures. The second part of the required asks us to prepare the extracts of the statement of financial position, the statement of comprehensive income, the statement of financial position, and the statement of changes in equity of entity A for the year ended 31st December 2023. Comparatives must be provided. So in the second required, it's asking us for the extracts of the statement of comprehensive income, the statement of financial position, and the statement of changes in equity of A for the year ended 31st of December X3, and we need to do our comparatives. So let's start with the statement of comprehensive income. And I think it goes without saying that you need to do a full heading, of course. So you would have the statement of comprehensive income of entity A for the year ended. But I'm just going to do it I'm just going to do shorthand so that I can save some space over here. Okay, but you get the picture. So we're going to have to do comparatives as well. So our comparative period is X2. So what would be the impact of the fair value of the adjustments that we've just processed? Well, in terms of our statement of comprehensive income and the information that we already have, we know now that there's going to be this new line item, okay, called fair value gains. And in the current year, the fair value gain was 110,000. That was what we recognized. And for the comparative period, if we go up here, we can see that the comparative period, we have a fair value gain of 190,000. So we would put that 190,000 over there in our comparative period. And then we can also just close off with our net profit for the year. Okay, and our net profit for the year, we are told that the profit for X3, there was a profit of 180,000. Okay, I'm just going to do a little working one over here and working two. So if I do working one over here, we were given that the profit is 180,000. Okay, but we must reverse the depreciation. So we're going to increase our profit by the 25,000 depreciation, and we're going to increase it to recognize the fair value gains. So that gives us a net profit of 315, and we can put that number in over there. And we're going to do the same thing for year two. So we're going to start off with a given profit of 150,000. Then we're going to add back our depreciation, and then we're going to add our fair value gain of 190,000. That gives us a profit of 365. 365,000 over there. Okay. So let's just put that 365 over there. Cool. Now, the next statement we can move on to is the statement of financial position. Okay, so again, I've got my comparative periods over there. And on the statement of financial position, for this investment property, the only thing really that we expect to see there is we expect to see our investment property, and the carrying amount of our investment property in X3 is going to be 1350, and in the prior year it's 1240. Okay, for now I'm just going to leave out the retained earnings, although I suppose I could put it in, but we're going to just do that in the statement of changes in equity next. Okay, so that's all we expect to see with the investment property. We expect to see the investment property being reflected at its fair value at those respective dates. Then the last extract we need to do is from the statement of changes in equity. Okay. Now, for the statement of changes in equity, the way we would do that is we're going to have our balance as reported. What was the comparative period is X2, so it would be the first of the first X2, and I'm just going to look at the retained earnings column. Okay, so our balance as previously reported, we were given a balance of 2 million. Okay, so that was given in the required. Then we're going to have to do a restatement, okay, for our change in accounting policy. And the restatement, so the cumulative effect of the restatement, let's think about what the cumulative effect of the restatement is. Okay, so if we go up here, we go back to our calculations, okay? Remember, we're looking at the balance now at X1. Okay, so that's the balance that we are looking at. Okay, so we've got to think about what has been the cumulative effect before that day. So we know that in the old policy, there was a depreciation of 25,000 that was recognized, but that depreciation now must be reversed, which means we're actually going to increase our retained earnings by 25,000 to reverse this 25,000 depreciation that was recognized. Furthermore, at that date, if we had applied the new policy, our fair value gain in the prior years would have been 50,000. So the cumulative increase in our balance, our opening balance would be 25,000 plus the 50,000, and that gives us a restatement of 75,000. So now we have a restated balance at 11X2, and that new restated balance is 2075. Okay, so that is our new restated balance. Then we can look at our profit for the year, which is also going to be restated because that is our prior year profit. And if we go up to our statement of comprehensive income, we can see our restated profit over there is the 365,000. So we can put that 365,000 over there. Okay, so that is our new profit. And then that's going to give us a balance at the 31st of the 12th X2, and that is of course a restated balance, and that new balance is going to be, okay, it's going to be 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 2440, 000. Okay, so we're just adding those together. And that is our new restated balance. Then in the current year, we're going to have our current year profit. Profit for the year. So our current year profit, if we look at our statement of comprehensive income, it's the 315 over there. So we're going to put our 315 over there. And then we're going to have a balance, our closing balance at the 31st of the 12th, x3. Our closing balance there is going to be 2755. Okay, so there is our closing balance. Okay, so that's what the statement of changes in equity is going to look like once we have done this restatement. The third part of the required asks us to prepare all the disclosures for the change in accounting policy as required by IAS 8 accounting policies, changes in accounting estimates, and errors. Now, the last thing we need to do is the disclosures that are required in terms of IAS 8. So if you remember in the slideshow that I did at the beginning where we discussed the disclosures, and you can jump back to that timestamp now just to refresh yourself. Okay, first and foremost, we need to disclose the nature of the change in accounting policy. So what happened and why did it happen? Okay, so I'm just going to do over here, let's just start with notes to the annual financial statements. Okay, and let's call this note number 10. Oh, no, let's make it note number 8 because of IAS 8. And we'll say change in accounting policy. Okay, so we've got to tell the users the nature of the change. So what happened? Okay, so the business decided to change its accounting policy for investment property from the cost model to the see what is going on here to the fair value model. Okay, so that is the nature of the change. Then we've got to explain why. Okay, so this was done model, okay, to more accurately reflect the business's financial position and performance. Okay, so we're just going to have a little story over there, and excuse my messy writing, but I'm just trying to get through the whole thing. Okay, so the important thing is remembering that you need to do that part, and now we need to actually show the impact on all of the line items that are effectively being impacted, and we're going to have to do it for the comparative periods as well. So we're looking at X3 and X2. Now the first impact, let's just think about what the impact is on the statement of, well, on the, if we're looking on the income expense side, okay, specifically the statement of changes in equity and the statement of comprehensive income, because those two kind of go together. Okay, so the first thing we know is that our opening retained earnings had changed. Now, opening retained earnings actually increased. So we can say there was an increase, okay, in opening retained earnings. Okay. Now, if we go back over here, if we go up here to our to our statement of changes in equity, we can see that in the prior year, the increase was this 75,000 over year. And if we're looking at X3, we can say the increase, so we'll have to go back up here, would have been, it would have been the cumulative effect up until that point. So we're going to be looking at the 190, right, plus that 25 over there, plus everything before that, okay, because that would have, up until that point, that would have been the cumulative change as at X2. Okay, I hope that makes sense. So in X2, our cumulative increase is 75,000, so that's the amount we restated. Now in X3, it would be the 75,000, right, plus 25,000, which is the depreciation for the year X2, so that brings us to 100,000, plus 190,000, which is the fair value gain for the year X2, right, under the new policy. So that brings us a cumulative increase of 290,000. Okay. Then what else happened? So let's think of our line items in the statement of comprehensive income. Our depreciation expense has changed. So we have a decrease in our depreciation expense. Now our depreciation expense in both of the years were 25,000. Okay, so if our depreciation decreases, then this is a positive effect on our profit overall. So notice how these numbers are all increasing profit, and I'm reflecting them as positive numbers, okay, because they're increasing the profits. What else then happened? Okay, so we have this new line item, which is called the fair value adjustment. So there was this increase in the fair value adjustments, and the increase in the current year was 110,000, and in the prior year it was 190,000. Again, these are increasing the profit, so therefore they are shown as positive increases. The next line item would be our increase, okay, in our net profit, and the increase in the net profit really is just these over here. Okay, so we're just going to have the increase over there, which is 135 increase, and then 2150. So that's just adding up those two, because the depreciation goes down, the fair value adjustments goes up, so overall net profit increases at that amount. Okay, and then the last thing that is impacted is we have an increase in our closing retained earnings. Now the increase in the closing retained earnings, if you look at X2, it would be the 215 plus the 75 over there, so that gives us 290. Okay, so that's the net impact on the closing retained earnings. And notice how, okay, notice how that is the same as that, and we expect those numbers to be exactly the same, because last year's closing retained earnings is this year's opening retained earnings, so we expect that effect to be exactly the same. Okay, and then the increase in the closing retained earnings of this year would be the 290 plus the 135, that gives us 425 over there. Okay, so that is the net impact on our retained earnings overall. Now, that's the one aspect. So that's looking at the statement of comprehensive income and statement of changes in equity. But we've also got to look at the financial position, okay? Because we've covered financial performance. Let's look at financial position. Okay, so in terms of the financial position, okay, what has happened? We actually, when we're looking at the investment property, remember I said that there's a sort of a reclassification from having it as this property cost account to an investment property, okay, which is now under the fair value model. So we're going to have a decrease, okay, in property cost, And for both of the years, it's going to be a decrease of 1 million, okay, because the property cost account would be sitting at 1 million. Then we're also going to have a decrease in our accumulated depreciation for our property, okay, because there would have been accumulated depreciation on the property, and then the net amount would have been reflected on the statement of financial position. Now, in the prior year, there would have been 2 years of accumulated depreciation, so that's 50,000, and in the current year, there's 3 years of accumulated depreciation, so that is 75,000. Okay, then we have this increase in investment property that is now recognized at fair value. So we're going to have an increase in investment property. So at the end of X2, the fair value is 1240. And at the end of X3, the fair value is 1350. Okay. And then lastly, we're just going to have a total here saying that we have an increase in our net assets, okay, because there's now a net effect over here on our net assets. And what is that increase? Well, if we add these up, we can see that in X2, it's 290. Okay, let's see what's going on over there. And then in X3, the net effect on our net assets is 425. And look at how amazing this is, right? When we look at the financial position and contrast it to the sort of performance aspect, we can see that these numbers tie up exactly, okay? And we expect them to tie up because these numbers all should actually be imbalanced, because what we've impacted on the one side is the same as the other. And think about what these totals represent, right? So an increase in our closing retained earnings that is represented by an increase in our net assets, right? Because our net assets impacts our equity, and our closing retained earnings is part of our equity. So that's the net effect overall on our equity. And once you've done this disclosure and you have these numbers matching, then you know you've done this 100% correct. Okay, so I hope that this example was useful, and it helped you think through the issues with with a voluntary change in accounting policy. Okay, like I said, if you have any questions, or if you want me to cover something else, or you need a bit more explanation or something, please leave me a comment below. Don't forget to subscribe to my channel so that you can be up to date with any new videos I release. Feel free to share this with anybody you know that needs a bit of help on their accounting policies, and I look forward to seeing you in the next video.